How will tariffs affect the interest rates as well as the housing markets in Canada? Hey, I'm Scott Peckford, and today on the podcast, I have Dave Larock. My good friend Dave is one of the smartest guys I know when it comes to explaining this stuff to people in normal, common language. He's got a fantastic blog that you can go check out. And I have Dave on a couple times a year, usually when something big is happening, and have him break it down for me. And we talk about how the tariffs or the proposed tariffs, how it can affect the inflation as well as interest rates. We talk about how that can also have what kind of impact that might have on the real estate market. And we dive into, I asked him what he's doing right now with his clients in terms of fixed, variable, what kind of term selection. These conversations are always fantastic. And honestly, this is the kind of thing that you're going to want to be able to talk to your clients about. So I highly recommend that you listen to this, take notes, and then figure out which sound bites you want to incorporate into your client conversations. Before I jump into that, I'm going to give a shout out to Ownwell. It's one of the sponsors we work with that helps homeowners monitor their home equity and buying power. And it's absolutely fantastic. You know, it's a tool that's similar to HomeBot in the US that I saw over almost a decade ago and thought, man, this needs to exist for our Canadian borrowers and brokers. If you want to check that out, and they got crazy open rates, 60 to 80% open rates and high engagement, creates conversations around mortgages and borrowing power. Check them out at ownwell.ca/Scott and check out this conversation with Dave. Hey, Dave, welcome back to the show.
Thanks for having me.
So, hey, I love getting to chat with you. You know, I try to get you on here a few times a year, especially when something's happening in the market that's affecting interest rates. And you have done a great job over the years. If you want to go back and listen to some of our previous episodes of really breaking down a lot of complex data into something that you could talk to a customer in a way that they go, oh, this makes sense. And the big topic going on right now is this whole tariffs, as well as, you know, what do you think that's going to do with the real estate and mortgage market? And so let's just jump right into that, I guess. So we probably, anybody, unless I don't know how you'd not know, but obviously there's been a lot of talk about tariffs since Trump's got in again. And so I'm interested to know what your thoughts are on tariffs, and let's talk about tariffs in relation to interest rates first before we dive into the real estate effect on real estate. So maybe talk me through that.
Sure. Well, so tariffs are taxes that a government places on imports into their country.
You know what? Okay, hold on. Pause 1 second. I love that you actually took the time to define, because I was just like, guys, I've been doing this for many years. And the first question I should have been define tariffs for anybody who doesn't know what that means. So thank you for doing that. You're making my job easy. Carry on, brother.
Yeah, no problem. Well, you know, when I write my blog, I'm not writing for insiders. I'm trying to, my target audience, every Sunday when I sit down to write, my target audience is a teacher who's smart enough to be a teacher but knows nothing about finance. And my goal is to bring them along so that they can understand what the concepts are. Because quite frankly, if you explain them in simple terms, they're not complicated. And people are intimidated by this stuff because a lot of times the insiders explaining it aren't simplifying enough. So let's start there. Tariffs are a tax that a government places on imports into their country. So when Donald Trump talks about putting tariffs on Canadian steel or Canadian aluminum, he's basically saying that every time an American producer wants to bring those things into the U.S., they got to pay a 25% tax at the border to bring it in, which is why it is, forgive my bluntness, asinine for him to stand in front of the microphone and say that this won't raise prices for U.S. consumers or U.S. producers and that the foreigners will have to pay. It just doesn't work that way. The tax is applied at the border when the stuff is coming into the country. So the tariffs that Trump is talking about will not affect Canadian inflation directly. What they will do is they will reduce the exports that the U.S. economy buys from the Canadian economy, and that'll be bad for our GDP. It'll mean that our economic growth slows. So if you're the Bank of Canada and you're dealing with that in isolation, then you are basically looking at that saying this is going to be bad for growth. And if inflation is stable, which it now is, we're right around our 2% target. We're well within inflation. All the key gauges are well within the Bank of Canada's 1% to 3% target range, which allows for some fluctuation. We came in at 1.9 last month. We were 1.8 the month before. We have flexibility the bank has flexibility to look at other factors. In other words, if inflation is at 8%, the bank has no choice. It has to raise rates and bring inflation down. But if inflation is at or near target, then the bank can look at other factors like the overall health of the economy. And if Trump is going to slap tariffs on Canadian exports to the US, that's bad for our economy. That makes the Bank of Canada more dovish. It makes the bank more likely to cut its policy rate to try to provide stimulus to the economy. Now, interestingly, the Bank of Canada's policy rate is currently at 3%. It isn't stimulating the economy until it hits 2%. By the Bank of Canada's own estimate, its neutral rate range is between 2.25% and 3.25%. So if the bank says, until the bank lowered its policy rate to about 3%, it was actually still acting as a brake on demand. It was constraining growth in the economy. So the cuts that the Bank of Canada has done so far are just taking their foot off of the brake pedal, the economic brake pedal. Okay. But if the bank wants to hit the gas and start stimulating our economy, its policy rate has to get to 2%, and it's still right now at 3%. Interestingly, and this is one of the stats I love to repeat in my posts recently, over the last 5 Bank of Canada rate cut cycles, going back more than 25 years, its policy rate has always bottomed at 2% or less. So if past is prologue and you're looking, saying, how low can the Bank of Canada go? The last 5 times it's engaged in a rate cut cycle, its policy rate has always hit 2% or less. So the bond market right now thinks the bank's going to cut by another 0.5%. I think the bank's going to cut easily by another 1%, because with all of this uncertainty around what Trump's doing, we need some insurance in the economy. Rate cuts right now are a form of insurance. And again, inflation isn't perfect. There are things that the Bank of Canada won't like about the most recent inflation report. We're a complex economy. There are always things that are areas of concern. But the bottom line is our headlines at 1.9%. All of our core measures of inflation are well within the bank's 1% to 3% range. It has the flexibility, and it needs to be dovish right now because there's so much uncertainty coming from the US and from Trump. Now, here's the kicker. If our government responds to US tariffs by putting tariffs on imports, US imports into Canada, US exports, things we import from the US, not trying to make that complicated, then that would be cause prices to go up, and that would potentially be inflationary. Now, here's an important detail. A one-time tariff would cause prices to go up, but the Bank of Canada can look through that. Its concern is when inflation pressures are broadening out and prices are starting to rise organically, and inflation expectations of higher inflation are starting to become entrenched. Because if you think that there's going to be more inflation down the road, you might accelerate some purchases today and buy stuff you wouldn't normally buy in order to avoid higher prices down the road. And if enough people do that, that will create inflation all on its own. So expectations of higher inflation can beget higher inflation. So that's another thing the bank has to manage. So if we slap tariffs on what the U.S. sells to us, then that would be a one-time event. Even though it would be inflationary, the bank could probably look through that as well. The thing the bank is watching most closely and is most concerned about when it comes to tariffs is something that we saw during COVID. When we were in the midst of COVID, there were supply chain issues that caused some prices to rise, and they did. But a lot of opportunistic businesses took a look at that and said, wait a second, everybody's expecting higher prices right now. The narrative is that prices are going up. We're not actually affected by these supply chain disruptions. Our costs aren't changing, but everybody's walking around expecting higher prices.
So then they raise the prices. Yeah. No, that totally happened. 100%. I saw that happen.
So they were,
and they reduced service. They're like, oh, we can't serve you anymore, but you're going to charge you more. Please, accept our apologies.
Right. So if we see a repeat of that and businesses decide to respond opportunistically and they raise their prices more broadly than is necessary as a direct result of the tariffs, that is something the Bank of Canada would be concerned about and ultimately might have to push back against. So over the near term, tariffs make the bank more dovish because they're bad for the economy, and whatever the U.S. charges our exports to them at the border doesn't affect our prices at all. If we have counter tariffs, those will be one-time price adjustments that the bank may well be able to look through. But ultimately, if businesses are opportunistic and general prices start to rise and inflation expectations become entrenched, expectations of higher inflation become entrenched, then ultimately that would concern the bank, and that there are scenarios where the bank would have to raise rates to push back against that. Over the near term, it means rates should drop, but over the longer term, it means the bank might have to push back against those broadening inflationary pressures and raise rates, and that's really the uncertainty that we all face right now.
Right. Okay. So I'm gonna try to unpack some of the stuff that you'd said there. So the one thing you talked about was the policy of 2%. So the last 5 times, again, no history doesn't always mean that it's going to happen again. But so the policy rate was to 2%, and right now it's at 3%. So is that what in your mind then if you use history as a guide, that you expect more rate cuts to happen in the next 6 to 12 months? Like when do you think we would hit that? When do you even with these threat of tariffs, that you're still expecting that that's going to happen? In fact, it may even make it more important that they actually cut the rates. Correct? Is that?
Yeah, the timing is when forecasters start to look foolish, because it's much easier to talk about the direction than it is the timing of when these things will happen. But and again, this may not age well, but if you ask me right now, gun to my head, I think we're going to at least 2% for the BOC's policy rate. And I would be surprised if it wasn't sometime this year, and probably sooner rather than later. One thing we have to keep in mind, though, Scott, Trump talks about tariffs a lot more than he enacts tariffs. So and to be clear, the threat of tariffs alone is damaging to our economy, because businesses are going to become more cautious in how they spend and invest. And if you're a business that operates on both sides of the 49th parallel and you're deciding where to build your next factory, you might well decide that you're better off building it in the US, because that's the main market and you could be subject to tariffs. And don't think Trump doesn't know that. He is well aware that just the threat of tariffs alone will be bad for the Canadian economy. And his stated goal is to weaken our economy to an extent where we come to him cap in hand and ask him to make us
give us, please do trade with us, like the port, looking for some porridge. The thing about that I think about when it comes to Trump, I mean, people, you got two extremes. People think that he's awesome. People hate him. But the reality is he's a business guy, and he's going to say extreme things because it actually gets attention. I think he gets attention from it, and he wants to negotiate. And so if you're going to say something ridiculous, like, it's not that he expects this, but like if he's trying to negotiate with our government, saying something ridiculous makes it feel like, oh, if they can sit down and negotiate a better deal, it feels like what are your thoughts on that? It seems to me like this is premeditated in order to make the negotiations go in a way that he wants them to go.
Yeah, this is his MO. His negotiating tactics are well known. He's a bully, and he wants to try to intimidate you, and his goal is to extract concessions. He wants to do two things. He wants to declare victory quickly so he can look to his base like he's a tough guy, because that solidifies his political support for more of these things that he's doing. And he did that when he said he was going to slap 25% tariffs on everything we sell to the U.S. We basically held up things that we had announced 6 weeks before, and he told his base, "Look what I've done. They've already capitulated."
Yeah, exactly.
Aren't I great? And of course, anyone with half a brain would say, "Wait a second, this stuff was all laid out in December. You didn't get anything new," but he doesn't care, because it's red meat for his base, and if they believe that he's kicking ass, then they get all excited about it. So number one, he wants wins that he can show people, because that's good for him.
Right.
Number two, the USMCA is up for renegotiation next year, and he wants to weaken us. Do I think he'd love to annex our country? Sure. He wants our resources. And ultimately, he wants to be the next face they put on Mount Rushmore. And ultimately, when he looks at a map, if he can double the size of the U.S., more than double, because we're bigger than the U.S. is, then of course he'd love to do that. And like a 5-year-old kid, until someone tells him no, he thinks he can get away with it. So we'll boo him at the hockey games for now. And I think a lot of Canadians I think the majority of Canadians are pretty offended by all this talk. And I think a lot of us would be willing to be a lot poorer than we are now before we'd ever.
Yeah, I mean, I can't imagine that. I can't see a world where like we become part. Like that's such a. I can't even see that as possible. Like even when he got in last time and he said we're going to build a wall and the Mexicans are going to pay for it. Like they didn't pay for anything. Like it's just an extreme statement that gets people worked up, and then it's like So I feel like there's a little bit of that going on. But you're right. He's playing a bit of a game here. But we're in the middle of it, and to some degree. And so, okay, so your thoughts are on the tariffs thing. It's just basically a tax on his people, not ours, on our goods, which will affect exports. We do a lot of exporting to the U.S. And so I've seen the Canadian dollar has gotten weaker. So what are your thoughts on? I'm going to get into other stuff, but what are your thoughts on this affecting our dollar? Because I'm going down to the U.S. soon, and I'm not going to lie, it kind of sucks how the Canadian peso is not doing well right now.
Well, actually, the loonie's up to 70 cents. It bottomed at 68 cents. And since the tariff talk was initiated, it's actually gone up a little bit. Now, a lot of that is people were shorting the Canadian dollar on bets that it would weaken. And there's a lot of
yeah. Okay. It's a little up today. Last time I looked, this was like a month ago, it was down a bit. So it's up a little. Yeah.
Yeah. So here's the thing. We rely on the U.S. more than they rely on us. Full stop. Their economy is 10 times the size. But Scott, and I wrote about this a couple of times in my recent posts, and I think it's an important point to make. The U.S. will feel the pain of what Trump is doing. Just to give you an example, U.S. inflation right now has gone up for 4 consecutive months. They're now up at 3%. We're below 2%. So their inflation is accelerating. Their government deficit is the highest in the G7. They're spending money like drunken sailors. And since Trump has come into office, that spending has accelerated. Again, he promised to cut government spending through DOGE. He's launched a bunch of new departments. And right now, the U.S. in the first 4 months of this year, in the first 3 months of this year, is slated to spend $640 billion. That's over $1.5 trillion by the time the year is done. And that will be unprecedented. That is inflationary for the U.S. So they've got rising labor costs. Their inflation has increased for 4 consecutive months. The Fed now isn't talking about cutting anytime soon. The bond market isn't pricing in another cut by the Fed until October. And the Fed's rates are higher. And ultimately, the U.S. economy needs lower rates to help it because the saving rates in the U.S. are near their 50-year lows, the household saving rates. Consumers are tapping into record levels of debt on credit cards to make ends meet. And the U.S. economy is overheating. If Trump wants to slap tariffs on everything that is being imported from places like Canada, he's put a 10% tariff on things being imported from China. That's going to be inflationary, whether he admits it or not, because he wants to perpetuate the fantasy that it won't raise prices. Well, obviously it will. So the cost of tariffs in the U.S. on a relative basis is going to create more pain because their economy has more inflation and their government has more deficit spending and they have lower household savings rates. In Canada, our Bank of Canada has more room to cut rates to buffer against the headwind of the counter tariffs, which we will likely enact. And for the record, which I fully support, eye for an eye when it comes to this stuff with Trump. And ultimately, our government, we have the lowest federal government deficit ratio right now, deficit to GDP ratio in the G7. We're at about 1.6. So we have more room, even though we're smaller and we're going to feel more pain overall. The U.S. economy is going to feel pain. They've got too much inflation as it is. They never got back to target, and now it's reaccelerating. And we have a little bit more fiscal flexibility, provided the money is directed in the right places. Not a given, but we have more fiscal flexibility to help out with some of the short-term negative effects that a tariff-related slowdown would bring. So again, I don't want to mislead anybody. I'm not trying to say that we won't feel more pain than the U.S., but let's be clear, they will feel pain as well. And Trump has promised them they won't feel pain. So that will be
that's not realistic. Right. Okay. So let's talk about the housing prices. So what do you think if the tariffs go through or some version of this, or even just like you said, the threat of tariffs has been enough to create some turmoil. What do you think it's going to do to house prices? So let's talk about like existing versus new rental, because I think there's some different, we got to separate those things out. So maybe just talking about like, what do you think about like existing house price sales? What's your expectation on that?
Well, fixed rates peaked above 6%, and now they're down in the low 4s. We're right back. We're a little below our long-term, our 25-year average 5-year fixed rates. So with rates having normalized to more, I don't want to say more affordable levels, prices are still high, affordability is still stretched, but the market couldn't work at 6% plus, and it is starting to work again in the low 4% range. So if rates stay where they are or go lower, and I think it'll be one of those two things. I don't see higher rates in our near-term future. That does help with affordability on a relative basis, and I think that will be good for house prices. There are pockets of weakness. New condo construction in Toronto has been a disaster lately. It's lousy in Vancouver as well. We're cutting immigration targets sharply. If we follow through on that, that'll also take away some of the demand that was propping up housing. And again, not all those new immigrants were buying houses, but they all needed a roof over their head. And
they got a rent, or somebody was buying the house that was renting to them, or was renting out their house and moving. Like there was still effect on demand, even if it wasn't.
Well, if more people are trying to rent, then people at the top end of the rental market decide they'll buy instead, and organically it pushes everything up. So adding demand to the housing market at any level affects demand at all levels of the housing market, certainly when it's to the extent of the kind of immigration that we had. And in a place like Toronto, a third of all the new immigrants come to Toronto. So that was definitely affecting demand in Toronto and Toronto prices. I'm not super bullish on house prices this year. I think there is a lot of uncertainty. I think the tariff stuff and the economic uncertainty is probably causing people to be a bit more cautious. But if we look at it from an interest rate standpoint, because interest rates, I think, will be the main driver of what happens with house prices. And ultimately, we've got a tailwind now. Rates are back to their long-term historical averages. We're a little below that now, and I think they'll continue to drop. And by the way, we were talking before we started recording here, and you and I were both noting that we had a busy January. So I think that the evidence of that is already there. There were a lot of pent-up savings in the sideline. People had been socking away some dough when rates got too high. There's lots of interest in the market, and good houses are still going quickly.
What in your current book of business, because everybody's a little different, are you seeing more refis, more purchases? Like in the last couple of months, what is the mix been for you, or renewals, or what are you seeing?
Well, I wasn't doing a lot of refis when people were coming out at 2% rates and refinancing.
No, fair enough. Rates. Yeah.
So I would say there's the refis as a percentage of my overall activity have increased. They went from almost none to, typically it's about half and half, and we're not far off that level. A lot of those 6% mortgages now are a pretty good deal to refinance down to 4%, and not for the reason that people think. Normally when rates drop, and this is a key point, and I don't think a lot of people in our business understand this. When rates drop normally, especially if you've got a mortgage from a major bank, yeah, the rates are lower and you could save some money on the interest costs, but the penalties are enormous. But here's the thing. The yield curve is still inverted, which means shorter term rates are still higher than longer term rates. And when you do an interest rate differential penalty calculation, and you've got, say you had a 3-year fixed rate at 6%, and the 2-year fixed rate today is higher than what today's 3-year fixed rates are, the IRD penalty at the major banks is 3 months interest. So what's unique about right now, rates have fallen, but the penalties that you have to pay to break the mortgages right now are the lowest I've ever seen in my long career in this industry. And I call people up and I say, hey, I can break your mortgage for 3 months interest, and here's how much it'll save you. And some of them say, well, great, Dave, but I think rates are going to keep falling and I want to hold off until the summer. And then I explain to them, well, if you're holding off till the summer, 2 things have to happen. Number one, hopefully rates go down. That'd be good for you. But short-term rates have to stay above longer-term rates. And when I say short-term rates, 1, 2, 3-year rates have to stay above 5-year rates. If the yield curve normalizes and now 1 and 2-year rates,
your penalty will crush your ability to do this.
Guess what? The rate went down another 0.25%, but your penalty went up by 5 times. And now the window's closed. So to me, the urgency to refinance your mortgage is not whether or not you think rates are going to go a little lower from here. It's when the yield curve normalizes, because the penalties will increase. Bank penalties will go up by a factor of 5. And at that point, it doesn't matter how low rates go, the penalty will eat the savings. And that's how it typically is with the major bank mortgages, because they use their posted rates. Their penalties are so much higher. But right now, we have a unique window of opportunity. Again, haven't seen this in my career, where because the 1 and the 2-year fixed rates are above the 3 and the 5-year rates, in many cases, you could break a major bank mortgage for a 3-month penalty, and that ain't gonna last.
No, that's a window that's going to close. And so can you just for anybody that doesn't understand, explain the inverting the yield curve. So in a typical, maybe explain what's in a typical market. You're going to see lower interest rates on shorter terms because that's typically, they're like, hey, but in this market, because of the uncertainty, we're seeing higher rates on these shorter terms than on the longer terms, or yield rather. And then that's creating this unique situation where normally the penalties do become, I wouldn't say punitive because we love our lenders, but they can be very expensive in a declining market because you're not getting out of that thing without paying for an arm and a leg to do it, right?
Yeah, I mean, the reality is a lot of times when rates fall, you could save 10 grand in interest, but your bank's going to charge you 20 grand. And to be clear, I don't love their penalties at all. I think they're unfair and I think they should be illegal. They use posted rates to boost the penalties that they charge. And that means that they don't just recover the lost profitability of the mortgage that is being broken. They make more money on the mortgages that break than they would have if they'd kept them on the books. And I don't think that's fair. And ultimately, I think customers should be outraged by that. But that's a topic for another podcast.
That's another show. Yeah, I agree. I'm trying to stay like, we've already brought in Trump. I got to be careful about how many people are going to be sending me hate messages on this whole thing.
Yeah, well, they can direct them to me because I'm going to tell you what I think. And quite frankly, if someone doesn't know want to know what I think, then they should know better.
What do I care? Okay, so how will the tariffs affect? You think the tariffs would affect in like new construction and or renovation? What are your thoughts on that? What's the impact of that?
It's hard to say because they'll do two things. Over the short term, they'll probably bring rates lower, and that should be bullish for activity. But if they create a lot of economic uncertainty, that will work the other way, and that could cause people to be more cautious and could hurt demand. So I don't have a confident prediction of how those two things will net out. I do think in the short term, rates are headed lower, certainly variable rates. I'm not as convinced that fixed rates are headed much lower because our bond yields are still following U.S. Treasury yields, even though our economies are looking more and more different by the day. Because our economies are so linked, we are pushed higher when U.S. Treasury yields rise. And ultimately, everything Trump is doing is inflationary, not just with Canada, but with China and with all kinds of other countries. And the threat of these tariffs is definitely causing bond market investors to price in more inflation, right, and rightly so. You asked a question a minute ago, Scott, just to touch on about the yield curve. Normally, and people who've been at this for a while will know this is true. They'll remember this. Normally, you pay a term premium when you want to borrow for longer. So if you want a 5-year fixed rate, you pay a higher rate than you do for a 2-year fixed rate, because you're getting 5 years of certainty on how much your payment will be instead of 2 years. And if you're an investor, you can imagine in a typical environment, investors say, if I'm going to put my money out for 2 years, I want this return. But if you want me to put my money out and lock it up for 5 years, I want a higher return. There's more uncertainty that can be introduced. And also, I don't know what the impact of inflation will be, but inflation will erode my return. And ultimately, the longer I'm putting the money out for, the greater the risk that inflation will increase and will erode my returns. When after COVID, when inflation was around 8%, it went the other way. Investors said, if you want my money for a year or two, I need a big return on my investment because inflation is going to erode a huge amount of my return. So I need a lot of money to lend it out for the next year or two. But if you borrow my money for 5 years, I'm willing to accept a lower return when we get out around years 3, 4, or 5, because I think by that point, the Bank of Canada will have brought inflation down and things will be more normalized. So I will accept a lower return on 5-year money than I will on 1 or 2-year money. And that made a lot of sense when inflation went hog wild, because it was a short-term problem. And if you had faith that eventually our central bank would do what it had to, including causing pain for consumers to bring inflation down, then you were comfortable with that bet. So what's happening, inflation has come down. And yes, we have more uncertainty related to trade and et cetera. But over time, investors are starting to be willing to accept lower and lower returns for shorter term investments, bond yields. Shorter bond terms. So the yield curve, normally goes like this. You pay, this is a 1 year, this is a 5 year. It went like this. This is a 1 year, this is a 5 year. Now it's doing this. It's flattening out. And when it goes like this again, and those IRD penalties are calculated. If shorter term rates are lower than longer term rates, IRD penalties increase substantially, and even more so if we're talking about using posted rates to trick the banks. Because the gap between their 5-year posted rate and their actual 5-year rates they lend at can be as wide as 2%. And the gap between their 1 and 2 year posted rates and the rates they actually lend at might be 10 or 20 basis points. And that's the trick, is they say, well, when we calculate your penalty, we're going to use the posted rates, not the actual rates. And because the posted rates are so much higher at the longer end of their mortgage term offerings, the penalties are.
It's like they're charging you a penalty for giving you a discount. Right? They're saying, oh, we're giving you a discount, but we're going to charge you a penalty for the discount. It's like, what?
Well, yeah, the way they say it, Scott, is we're giving you a discretionary discount. And when we calculate your penalty, we're not going to apply the discretionary discount. We're going to charge you that ridiculous rate you never would have paid when we calculate your penalty. But like I said, right now, the trick is they didn't do this. They probably aren't happy that it's worked out this way. In fact, I'm sure they aren't, because you can break their mortgages with a 3-month interest penalty. But for as long as 1 and 2 year rates stay where they are now, and they're already falling, they're dropping all the time. But for as long, based on where they are now, being able to break a bank mortgage, think about it, at 6%, you got clients paying 6%, rates are at 4%, and you can break the mortgage for a 3-month interest penalty. When you do the math on what the savings is, take an amortization calendar. I mean, ultimately, an amortization schedule, people should have an Excel spreadsheet that does this quickly in our business so they can work this out. But so many times when I do the math now, the savings is, say, 12 grand and the penalty is 3 grand. So you email a customer and you say, hey, you want to save 9 grand? Here's a spreadsheet that shows you how much it costs to break the mortgage. Here's how much you'll save. And all we got to do is set the wheels in motion. I mean, talk about low-hanging fruit.
Right. Yeah, that makes sense. Okay. So in this market, so I'll kind of wrap up with this. So let's say I'm a teacher and I've got good income myself and my significant other have good income and conventional. And I'm talking about mortgages right now. What term selection are you looking at? Are you thinking variable? If I said give me your thoughts. Yeah, I'm not saying choose for me, but give me your thoughts on variable versus fixed in the current market that we're in. If I'm a qualified borrower that's not like I'm curious what you'd say to me.
Okay, so the bottom line is the first thing I say, and we should all say when someone asks me my opinion on rates, is as much time as I put into researching that question, I can't see around corners. And if you're looking for certainty, my opinion in $2 will only for sure ever get you a hot cup of coffee. So we have to qualify what we say because people are going to trust us. We are experts. We know more than they do, but we can't see around corners and we should never pretend that we can. That said, if someone says to me today, and I rephrase the question, they say, should I go fixed or variable? I say, well, let me spin it a different way here. I think, hand on heart, right now, based on my read of the tea leaves, that variable rates are going to prove cheaper over the next 5 years. I think they're going to save money. That is my opinion. I think they're going to fall over the year ahead. And ultimately, I think they will average, the cost of a 5-year variable will average out at less than the cost of a 5-year fixed rate today. But variable rates are affected by a whole lot of different variables. The other thing I think we got to remember is a 5-year variable rate term is long enough for the current rate cycle to run its course and for rates to come up on the other side, right? 2-3 years from now is enough time for Trump to stop talking so much about tariffs, for the economy to recover, for inflation to pick up again. And it's certainly possible. I tell anyone taking a variable rate, don't just expect they're going to fall and they're going to stay at the bottom. They're not going to. They're probably going to come back up the other side at some point over the next 5 years. And you should only take a variable rate today if you're prepared for that to happen. That's number one. Number two, there's nothing wrong with stability of a fixed rate. And if you end up paying more for a fixed, you're buying rate insurance. And insurance is a good idea if you don't like risk. And even if it ends up costing you more, you still got the insurance. And ultimately, for a lot of people, especially first-time buyers, the stability of a fixed payment is very important.
Right. Okay. So that's a very eloquent way to tell them. You're not going to tell them completely how to do it. You're just going to, I like the way you explain that. You'll end up paying. You may end up paying more for a fixed rate, but it's like insurance, and so then it makes them go, okay, I'm all right with that scenario. And so are you finding right now that people are in your, everybody's book is different, their market's different, but are they going for shorter terms? Are they, as a variable, seem to be more popular? Like if you were to look at it as an aggregate, knowing that every individual client is a different situation, I'm curious what you're noticing.
So the first thing is, Scott, I don't try to take anybody where they don't want to go. If they're really on the fence, I work through it with them and through the advice and the assessment that I give, that helps them reach their conclusion. But I don't take anyone where they don't want to go. It's ultimately their decision. And as I remind them, you're the one who has to live with the consequences of this decision. An apology from me won't count for much if you ended up zigging when you wished you'd zagged and it costs you a lot of money. Today, people who want fixed rates in my pipeline, generally it's 3 and 5 year. It's really used to be mostly 3 year, almost entirely. When rates were up around 6%, I was strongly advising folks to go with a 3 instead of a 5, because I did expect that rates were going to fall. And again, didn't take any more where they didn't want to go, but I think it made a lot of sense then not to be locking in for too long. And ultimately, people took that advice. I wasn't doing any 5-year fixed rates when they were above 6%. Now that they're down in the low 4s, people who by and large are happier with a 5-year fixed rate and don't want to overthink it, they're going back there. I would say I probably 60-40 3-year fixed versus 5-year fixed right now. But overall, I would say I'm doing a third or more variable rate now. So I made that a little more complicated than I needed to. Let's look at it a different way. I'd say right now I'm probably doing.
I'm trying to split the math here, but I think I'm tracking with you, but maybe dumb it down for me.
Let me simplify that. I would say I'm probably doing 1/3 variable, 2/3 fixed, and of the fixed rates, I'm doing a little bit more 3-year fixed and than I am 5-year fixed, but I'm doing a decent amount of both of those.
Right. Okay. So there's a mix across there, the different rates. And then if somebody does take a question on this, is there any strategies beyond just like ride it out? Or do you ever have do you offer again, every markets can change, but would you be recommending to people, hey, we'll keep an eye on it, and at certain points we would look at doing something midterm, or would you just leave it for the term?
Well, I certainly offer my counsel to all my clients on an ongoing basis. So, and they do call me midterm and say, I'm thinking about locking in. I know there's a popular strategy out there that's getting bounced around that people say, well, I'm really more comfortable fixed, but I think rates are going to keep falling. So I'm going to go variable and I'm going to convert midterm. And I try to talk people out of that strategy for a few reasons. Number one, we all imagine that we can time the market, but nobody rings a bell when the right time to lock in is. And the example I give is when COVID hit and rates were below 2%, you could have a variable at 1.5 and you could have a fixed at 1.79. People who went variable said, I'll go variable, but as soon as it looks like I should lock in, I'll lock in. Well, fixed rates went to 3.5. Variable rates didn't move. So now a guy calls me up and says, yeah, Dave, maybe I should lock in my variable rate. Okay, you're paying 1.5. Okay, what can I get for a fixed? 3.5. You mean I got to pay 2% more to lock in a fixed rate? That's nuts. Who would do that? No way am I going to convert. Well, variable rates went up into the mid 6s. So that would have been the smart thing to do. But at the time, it's like the boiled frog syndrome. You're sitting in the pot. It's only getting a little bit hotter every day. Don't imagine that you'll be able to time the market perfectly. That is a fool's errand. Number two, when you want to convert from variable to fixed, you have to convert to a fixed rate term that is equal to or greater than the time you have remaining on the variable rate mortgage. So 6 months from now, if you decide rates have bottomed and you want to lock something in, you got one choice. You can take a 5-year fixed rate and lock that in. And lenders are never going to be as aggressive on the rates they offer at conversion as they are when you're walking through the door. And by the way, the rates I can offer when you walk through the door are more aggressive because I'm getting paid a commission. But when they call to convert, there's a penalty if you don't take the rate, and there's no commission that I have to work with to buy down the rate if that's something I want to do. So the rates aren't going to be as good. So number one, don't assume you can time the market. No one rings a bell when the right time to lock in is. Number two, you're limited in terms of what you convert to by the time remaining on your variable rate mortgage. And number three, I am not as convinced as everyone else that fixed rates are going to drop a lot more. I was saying that before Trump's tariff talk, and if he does a lot of damage to our economy, they will drop by more than I had expected that they would beforehand, but I still don't think that that's a sure thing. And ultimately, my advice to borrowers is pick a strategy and stick to it. Variable rates prove cheaper over time, but generally not if you panic and lock in to a fixed rate. You got to ride it out. And ultimately, if you take a variable rate on the bet that fixed rates are going to fall and they don't, and you end up stuck in a variable rate that you really didn't want on a bet that didn't work out the way you hoped that it would work out, then to me, you end up with an ill-fitting suit. So I think you got to decide what you're comfortable with, stick to a long-term strategy. Don't think you can time the market. Ultimately, I think that's a fool's errand.
Yeah, that's good advice, man. Well, hey, where can people find you online if they're wanting to check out your blog and stuff?
My name is David Larock. They can type me into Google, or they can look up my company, Integrated Mortgage Planners, or moreplan.ca. And my blog posts are also featured every week on Move Smartly, which is a real estate website that I work with. And sometimes I'm quoted in the media, so I'm not always sure what they'll pick up, but I stick my head up every once in a while.
And definitely if you're listening to this and you're in the mortgage space, go read your blog. It's a fantastic resource. And you simplify stuff for people. I mean, yeah, I always joke, my IQ goes up when I talk to you, but then it drops pretty quick. By tomorrow, this will be like, what? It won't make as much sense. But I like your advice on the people trying to time the market and stuff. Like there's a lot of variables there that you cannot control. And we're giving an illusion of more control and power than we have, and you're going to probably end up with clients that are going to be pissed at you when this whole thing plays out. So,
well, interestingly, Scott, if I could I know you're wrapping up, but let me just say one thing. When variable rates went to the moon, not a single client called and complained to me that I had pushed them into a variable and when I talked to them and I expressed my sympathy, they went out of their way to tell me, Dave, you warned me, you went through it with me, you told me that you didn't know what the future would hold and that there was risk in the decision. And ultimately, I think that's what you have to do. You certainly don't want to take people where they don't want to go, and you don't want to project confidence where you have no right to have any, and you can still do your research and add value without making it sound like you can see around corners.
Without making ridiculous claims. You can't, and don't pretend you can see around corners because you can't. Hey, thanks again for listening, and hopefully you found that conversation with Dave useful. I know I always do when I talk to him, and again, I'd recommend that there's certain sound bites in there where he breaks things down, and I would take that and then use your own version of it. In fact, ChatGPT would be a great way to do that. You can take some of that language, that scripting, and insert, get them to try different ways to talk about it and then figure out what resonates for you. And, again, I think thank you, Dave, for coming to always chat with us and break stuff down. Check out his blog if you're looking for ideas. I think it's a great resource for anybody in the mortgage business that's trying to have some conversation points around these topics because their clients want to know. And I love how Dave frames it. Like no one got upset at him that took a variable, even though myself included, variable rates went up a lot. And it's because of the way he frames the entire conversation. And so I think that a lot more mortgage brokers could do well by copying this, how he handles that whole conversation. Thanks again for listening. And as I always say, there's no problem in your mortgage business that someone else hasn't already solved, like how to have these conversations with your client that Dave talked about today. The problem is who's got the answer. This podcast provides some of the answers. At least that's our hope. Thanks again for listening, and I will see you on the next episode.